Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. You're listening to the Leading Practices in Treasury podcast series. This 6-part series draws from the second ebook in the professional development series produced by Strategic Treasurer, a well-known treasury consulting firm, and CTMfile, a trusted source of corporate treasury news. The ebook, also titled Leading Practices in Treasury, delivers actionable recommendations and insights into some of the most critical areas of the treasury function. We invite you to download the ebook or listen to the audiobook by visiting strategictreasurer.com. This podcast series highlights key themes from the ebook. In the second episode, we'll focus on bank account management and architecture. I'm Pushpendra Mehta, your host. Joining me today is Paul Galloway, Senior Director of Advisory Services at Strategic Treasurer. Paul, it's great to have you with us. We appreciate you taking the time to offer your valuable insights.
Yeah, thanks for having me back, Push. Always a pleasure.
Paul, banks need corporate treasurers just as much as corporate treasurers need banks. This timeless truth reinforces why cultivating a healthy long-term relationship with banks remains imperative. But beyond managing relationships with banks, treasury teams must also adeptly manage the accounts they hold at each bank. To start us off, what exactly is bank account management, or BAM?
Yeah, Push, good question. BAM, or bank account management, at the heart is the process and procedures for managing your bank accounts across perhaps several banks for an organization and multiple bank accounts. Some companies can have lots of banks, lots of accounts. Being able to manage that in a way that is efficient can be a challenge for companies, especially if they're doing it manually in spreadsheets versus using a system or a platform to help them manage it. And so you can think about bank account management in these broad key areas. The first area is opening and closing bank accounts, having a process for how you effectuate opening. You know, that initial request, the process you go through for justifying opening the account, going through the process of contacting your bank, going through the bank documentation that's required, opening the account, making sure that it's tied to any systems that it needs to be tied to, and starting to utilize that bank account. It takes a little time to do that. There's also accounting aspects tied to the bank accounts as well, because you got to do reconciliations, you got to track the balances and the activity in the accounts. The flip side is also closing an account, having some type of request to close a bank account, why the rationale, reason behind why you're closing it, and to ensure that it gets done within a time frame that's suitable for the organization. You don't want to let something linger for a long time. You want to make sure that it's done within an appropriate bandwidth. The other area is around bank structure, you know, how you have your bank account structured, the relationships that you have, what banks do you lean on for what types of products and services. It could be very niche-y, or it could be very broad in terms of how you're using your bank. But you know, you want to have your structure put together in a way that's efficient. Managing that structure requires some level of visibility to all your bank accounts and how they interact. The other areas around use of services, being able to track the services, the fees that are associated with those services, ensuring that your bank isn't overcharging you for services or charging for services you didn't request or sign up for is part of that process, and making sure you have the right services in place so that you can effectuate the movement of cash in a way that is appropriate for the company. And then tracking the bank documents. Anybody that's opened accounts at a bank, there's a lot of documents required. The bank is going to do a thorough background check if it's a new relationship. So KYC requires a certain level of documentation from the company. And then they also require a certain level of documentation to be filled out by the company. How that is tracked and monitored, ensured that you have all the appropriate documents in place and the ability to find those documents easily can be a challenge for organizations if they're managed strictly through perhaps a share file platform on their network. Being able to figure out where somebody had put documents in the past may not be as intuitive as one thinks. So sometimes systems can be much more useful than utilizing just a shared drive. The other areas around your signatories are the people that have administrative rights to engage in activity or authorization for activity with a bank. And so this is about, internal documentation that assigns authority, corporate resolutions, signatory docs, that you got to track those as well. This can be really important when people are new to the organization and are assigned those rights, as well as people that leave the organization or change positions within the company and no longer need that type of authority to sign or authorize or approve. So bank account management can be really important to a company.
That's a very helpful explanation, Paul. Paul, you mentioned visibility. One of the key challenges for corporate treasury is the quest for daily and real-time visibility over cash. Why is it important for a company to have visibility to all of its bank accounts?
This is really important. So from a treasury perspective, if you don't have visibility to all your accounts, well, it's really hard for you to protect what you can't see. So it's really critical that treasury has visibility to all accounts. It can't be just to, oh, these are the core accounts that have most of the transactions. We really don't worry about these other accounts. You need to worry about all of them. It's your job as a treasurer. We tend to view a treasurer as superintendent of payments. So they have the overarching authority to set the tone for how you manage all the cash. Well, that means you have to have visibility to all the cash. So when you have that level of visibility, that helps improve liquidity management, risk management, the ability to ensure that you're optimizing the level of cash that you have within your bank accounts, as well as optimizing the return or the yield that you get in your cash. So you put that cash to work as well. Sometimes people don't think about that with Treasury, but they're responsible for the short-term investments. And just like any organization that has an investment team, the Treasury team wants to do the best they can for the company as well. So ensuring that you're getting the best return on your cash requires visibility to ensure that you're optimizing at an appropriate level. A couple items that I just noted, just jotted some notes around surveys. Our survey that we have out there, it showed that 18% of the respondents discovered that they had bank accounts that they didn't know. They were open and they had no idea they'd been open. That's quite a few. 18%. It's not zero. It should be zero. Obviously, it's not 50%, but still, that's not uncommon. We've had clients that when we go in to do assessments and we start looking at things, they're like, oh, wow, we had no idea we had these other accounts. They didn't have visibility to them. Somebody opened them and they didn't know. When I worked in an insurance company and built out a treasury platform, I got in there and I found out that there was multiple accounts that were being opened by people that didn't have authority to do that, but yet the bank was allowing these accounts to be open and Treasury didn't have visibility to it. Of course, there really wasn't a Treasury team until I came on board, but we changed that. All account opening and closing goes through Treasury today. We had 100% visibility to all accounts when I left the organization. You got to have that. So this same survey, when we talk about visibility, 35% of respondents report having 100% visibility to all bank accounts. Okay, so 18% didn't know accounts were open, but only 35% of the respondents had 100% visibility. You need 100%. And so that's 65% of the respondents that didn't have 100% visibility to all accounts. That's a problem. Organizations need to make sure that they know where all the accounts are and where all the cash is.
Well, Paul, thanks for breaking that down so well. Paul, payment security is always top of mind for corporate treasury professionals. And in this context, it is believed that effective bank account management is vital from a security standpoint. How does BAM impact security concerns?
Yeah, so BAM can be closely tied to fraud prevention. So having that level of visibility, just being high visibility to all accounts means you know all the transactions that are coming through. You have visibility to it. You can see it. When you utilize technology today to help you, it could be AI of some kind or machine learning or just through your daily auto reconciliation process, you can find anomalies where something doesn't look right. And fraud prevention is super important, but detection of fraud is also important. You can't have that without visibility because speed to recovery matters. The faster you can respond to any potential fraud or fraud that's been committed, the greater probability or chance that you're going to recover some or all your funds. So you need to be quick to it. Having visibility helps you. Good BAM yields good fraud prevention. Now, something we haven't talked about yet that you also need to have is you need to have a bank account management policy in place that guides how you set up processes and procedures, outlines the things that we're talking about here today. You need to make sure you have something in place. So when it comes to services that a bank can provide to help protect your payments, you can utilize debit filters, which means you can filter things in or out. You can do debit blocks, what prevents certain things from happening. You can set up lists. I like to call it whitelisting. You've probably heard of that term before, but whitelisting just says, hey, these are the folks that we're going to make payments to. We're not going to make payments to anybody that's not on this list. Not on the list, they don't get the payment. Electronic pre-authorization. You can utilize that to help pre-authorize payments or transactions that are going to occur. We talked about pause pay or pay match pause pay. These are great services. Every company should be using these. If you're effectuating payments on a regular basis, using these services will help prevent fraud. So you need to lean on your banks for the products and services they have. When they bring something to you, you need to listen to what they're saying. If you don't have it, you probably need it.
That's a strong point, Paul. Security vulnerabilities often arise from poor account oversight, so your emphasis on BAM's role here is vital. Let's shift slightly to what extent do a company's operating needs influence its approach to bank account management?
Yeah, operating needs of an organization can change over time. So we talked about this idea of organic growth or through acquisition. The use of capital for organic growth typically is around development of new products and services. Acquisition is another approach to growth where you acquire another organization or perhaps you merge with another organization. So these types of activities matter. Understanding the operating needs of a company, whether you're a manufacturer, a non-bank financial, or somebody else, everybody has a need to effectuate payments. Everybody has a need for capital or access to credit at some level. They're either getting access to capital from their own organic growth or they're getting it through their banking partners. So when you have conversations with your banking partners, we talked about transparency before, making sure that they understand your business in the near term and long term. So over the next 12 months, next 3 to 5 years, that will help your banking partners understand how they can grow with you, how they can provide the products and services that you need. So you need to have those relationships really close to you and provide them with that level of operating expertise that they just don't get from looking at the outside in. So you got to bring them in so that they can be flexible, can scale with you, can provide you also advisory services as you continue to grow as well. So there's really no compromise when it comes to security and visibility in today's world. Having visibility, having a level of products and services to help protect payments is a must, especially today. You got to utilize technology to fight against fraudsters and what they're going to do to organizations to steal money from them. So company really needs to take these items into consideration, and if you're not communicating that with your bank, they're not going to be able to provide you the products and services that you may need. So sharing the operating needs with your banking partner will help ensure that you have what you need when you need it.
Wise words and well articulated, Paul. Tailoring BAM to operational needs is clearly a smart move for maintaining efficiency and flexibility, including taking care of these security aspects. Let's now talk about leading practices. What are some key leading practices that Treasury teams should follow when it comes to BAM?
This is a good question, and this is not fully comprehensive, but it will provide, I think, some of the good areas that I think any organization that's practicing solid BAM or bank account management should engage in. The first area is around maintaining an inventory of all your bank accounts. All those bank accounts that you have to have visibility to should have an inventory of them. You should also be aware of what the accounts are being utilized for. So it's banking services that you have, it's what they're being used for. This inventory needs to be updated and maintained as things change. The other area that organizations should think about from a BAM perspective is moving away from manual processes. If you're currently utilizing spreadsheets, there are systems and platforms out there that can help automate certain aspects of BAM. You can have it in one area. You can generate reports. You can track things. You can store documents. These platforms are designed for helping companies manage BAM. You need real-time visibility to all accounts, legal entities, and banking relationships. You need to have that overall picture. So it's inventory of those bank accounts. It's all the legal structures associated with those bank relationships that you have. The other areas around streamlining your bank structure, optimizing the number of accounts you have, utilizing perhaps concentration accounts, utilizing controlled disbursement accounts, utilizing collections accounts, setting up structures that can automate the transfer of cash from collections to concentration to disbursement. This automated process eliminates manual movements. Also, the ability to effectuate these transactions under this structure gives you visibility, clear visibility to the specific types of transactions that are occurring. Disbursements separate from collections, and your concentration accounts not being clouded with all the normal activity that a company engages in. So this can be really efficient. Also helps a lot with research, reporting, reconciliation. It can be a real good tool to streamline and automate some of the traditional treasury processes that have been in place. Another area is use your bank services. You need to take a good inventory of the services and products that a bank offers and what you're currently utilizing relative to the type of activity that you engage in. So this would be services at the account level and transaction level controls. Your banks are designed to provide these. These will help you.
Thank you, Paul, for the nuanced insights. Let's now turn to structure. In addition to managing accounts, Treasury must also take an intentional approach to how bank accounts are structured. What does the basic framework for bank account architecture typically consist of?
Yeah, I kind of touched on this in my response before. It was unintentional, but I want this direction when it comes to bank account structure. We typically advise clients, especially the clients that are a certain size and certain volume of transactions or complexity within the organization, that you isolate the transactions that occur. So you have a structure of collections accounts. That's all these accounts do. They collect the receipts that come into the organization. Then you have controlled disbursement accounts. These accounts are designed just for disbursements. They can be very specific to a type of disbursement that occurs. Maybe it's just purely ACHs or wires or checks. You can divide it up. It can be tied to specific legal entities. The disbursement accounts are controlled. They don't do anything else but disperse cash. In between these two, collections account, disbursement accounts, you have your concentration account. This is the pass-through account where everything that comes in and everything that goes out. So everything that gets collected and then everything that goes out for disbursements are tracked through that account. It doesn't have the noise of the actual transactions, but it's the area where cash resides and sits. And then you have the ability to automate the transfer of those funds between these accounts and the concentration accounts through zero balance accounts. So you can automate how those transfers occur so the excess funds don't sit idle. They can get consolidated into the concentration account, and those can be invested overnight or on a longer term basis depending how much excess cash you have.
Thanks, Paul. That gives our listeners a great blueprint for organizing their account structure in a logical, scalable way. What about benefits, Paul? What are the advantages to this type of bank account architecture?
Yeah, some of the advantages to structuring this way is around mobilizing funds for efficient cash management. So this means that you truly are optimizing the level of cash that you hold within accounts. So you don't have excess cash sitting in collections accounts. You don't have cash sitting in disbursement accounts. It gets all consolidated in one area, which allows you to have one visibility to your cash position and be able to optimize the level of cash that gets invested so you can increase the yield or return on your cash. It isolates specific activities. We talked about the ability to, with your controlled disbursement accounts, to be very specific in the type of payments that occur. You got payroll, you've got ACHs to vendors, you got checks that go out, you have wires that go out. You can be very narrow in what those particular accounts are designed for. I talked about centralizing visibility through the concentration account, having the overarching ability to understand where cash is at any given point. It's really easy when it's going to reside in one account at the end of the day versus multiple accounts and trying to add those all up, especially if you're doing that in spreadsheets and not utilizing a platform like a aggregator or a TMS to help you manage that. It helps with decision making. So it's not just around the investments itself, but also in terms of making tax payments, debt payments, or other capital initiatives that the organization might have. It also makes the fund movements more predictable. Having this kind of structure provides visibility to very specific types of transactions. You can forecast better with that. You can use that data and information over time to predict better how cash flows are going to work, how it looks, the types of flows that happen. And it also helps prevent errors from occurring. More errors. It helps with fraud prevention as well, because you're able to isolate things. You can see anomalies a lot easier. If you have everything running through one account, collections, disbursements, all through one account, it's much more difficult to pick up on the anomalies that occur. When you divide them out this way in this kind of structure, you can see things that are abnormal and then react to them. Of course, doing daily auto reconciliation is an important aspect as well. Being able to reconcile those accounts on a daily basis is really important. A couple other items when we think about, as an example, for errors, so disbursements from a collections account. If you see something coming out of a collections account that is not going to the concentration account, that's an instant red flag. that's a great way to be able to detect where somebody's got a hold of bank information and execute a transaction that shouldn't occur. Another area is you keep separate or call out accounts, different types. I talked about ACH checks and wires. When it comes to the separation of these, the controls that you put in place, such as debit blocks, debit filters, the whitelisting, those kinds of things, that helps as well. And it gets it specific to just those types of transactions where having those controls, it locks it down even further. So those disbursements, when we talk about controlled disbursement accounts, it's having these bank offered controls in place that allows you to protect those payments more in the activity that occurs in the account.
Thank you for highlighting the advantages, Paul. Finally, pooling is a topic that often comes up in this context. What are the most common types of pooling Treasury teams should be aware of?
Yeah, so that's a good question. So I'm going to probably be talking a little bit here on this topic. There's a couple key areas when it comes to pooling. Most people are probably familiar with physical and notional pooling. And so I'll talk about those first, and then I'll talk about another type of pooling that's typically tied to insurance companies, because it's a little unique, but I think it's important to talk about that as well. But when it comes to physical pooling, it's the ability to take cash and concentrate it into a single centralized account. So this is physically taking all the cash, putting it in one account. So all these accounts, put it all in one. That helps manage liquidity and risk. So being able to have it all in one area provides all that visibility, greater control of where all the cash is at. The other thing is that you can do this all through ZBA, such as the use of a concentration account. So kind of what we talked about before. With your bank structure, you can structure it in a way everything ZBAs to a single account, provides that level of visibility. The automated movements of cash will help aid in lowering borrowing costs, reduce the reliance on external debt. It optimizes interest and working capital for an organization, and also helps with the liquidity management as well. So physical pooling is something that's relatively common to engage in for organizations that have lots of accounts and lots of cash, and being able to manage that more efficiently. Physical pooling helps them do that. There is a counter to that, and that is the idea of notional pooling. Now, this is not actually physically concentrating all the cash into a single account, but instead what it does is it takes all the balances within the accounts and it combines them together so that you have one view of all cash in totality, although it's not in one account. Some of the benefits associated with doing this versus physical pooling is you can do it without sacrificing regional or entity autonomy. For organizations that are global, have lots of legal entities, notional pooling can make a lot of sense to them. The physical gathering of all cash for an organization that's like that can generate some challenges. So notional pooling tends to be a lot more popular for global organizations or like European-based organizations. Anybody that's dealing in multiple currencies, multiple locations around the globe, lots of legal entities. This can also be bank dependent, so not all banks offer this. Some banks do offer the multi-currency or cross-border notional pooling, so you need to be aware of what banking partner can provide that kind of service to you. It does allow for this global pooling of cash. It will help optimize your interest costs. It will reduce expenses or interest spreads. If debt balances are fully or partially offset by credit balances, the company receives a higher return or higher interest income. So being able to utilize a platform like this to gather things together will help them manage that a little more efficiently. When you think about notional pooling, it's really kind of, in some essence, it's like a form of bank lending. So banks will require cross guarantees. They'll require full legal right of balance sheet offset or interest set off over the pool accounts. So these are some considerations you need to think about when it comes to the notional pooling. It's more complicated than physical pooling because you're having to deal with notional balances, meaning you're not physically moving the cash. There's only, certain major treasury centers where this particular type of pooling is occurring. Hong Kong, Singapore, London, Europe is typically where you're seeing this. In the U.S., notional pooling is not allowed. So you can't do it in the U.S. You do physical, you can't do the notional. Now, the other area I wanted to talk about, and this in particular is tied to insurance companies. Insurance companies have a lot of assets that are backing liabilities of the products and services that they offer. So this is really tailored to insurance company, and that's short-term investment pools. Sometimes you hear it referred to as a STIP. So STIP is a way to consolidate cash into a pool facility for larger strategic investments. Insurance companies do this a lot. You might hear organizations talking about general account balances at an insurance company. These are the pooling of the cash that's invested in a variety of investments. They're typically bonds. Doesn't mean that insurance companies might not have a certain level invested in more equity-like instruments, but you typically don't see that because they're regulated. So you have insurance regulators that are overseeing the management of those assets. So they are restricted somewhat in terms of what they can do, but the ability to utilize these short-term investment pools is real beneficial to insurance companies. It can reduce their transaction costs because they can do larger transactions. Larger volume tends to mean reduced costs with counterparties. They can also get better yield or return on the investments. It simplifies their investment process because it gets aggregated into a single pool, and it provides greater liquidity to the organization as well. And management of that liquidity. They can also get better returns on the yield in the short term. So those are the three types of pools we typically see when it comes to pooling.
Insightful as always, Paul. Your breakdown of pooling types brings the topic to life for Treasury professionals looking to optimize liquidity. We've come to the end of this episode. Paul, a sincere thank you for sharing your expertise. To our audience, thanks for listening. If you found value in today's discussion, hit subscribe and share this episode with your colleagues. We'll be back soon with more valuable conversations in the corporate treasury space. Until then, keep learning and leading. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.